Last year, a company in India lost almost 6,000 crore rupees. This year, it's walking up to you and asking for 8,000 crores more. And the wild part, I'm sure people are going to line up to hand it over. So here's the thing, that 100 rupee order showing up in 10 minutes feels like magic. Feels like India finally leapfrogged. Instant everything, the future delivered. And for about 4 years, that's the story everyone told: convenience, tech, and progress. Here's why that story is wrong, or at least why it's hiding the real one. The real product was never groceries, it was growth bought with other people's money. And the someone whose money it is, for 4 years, it wasn't you. But that's about to change. Stick with me because by the end, you'll see this every single time you open one of these apps. And you'll know exactly who's paying for your convenience and what happens the day they stop. First, let's kill the confusion. Blinkit, Zepto, Instamart, these are not shops. They're not Amazon either. Amazon ships from a giant warehouse on the edge of the city and it reaches you in a day or two. That's just e commerce. This is quick commerce. These guys do something a little different. They build a network of what the industry calls dark stores. Now, I'm sure most of you already know what dark stores are, but just for the sake of the video, let's do a quick definition of it because we lean on it on the whole story. A dark store is a tiny warehouse no customer ever walks into. That's why it's called dark, tucked inside your neighborhood, stocked with roughly 2,000 of the things people panic order: milk, eggs, Maggie, chips, a charger, croissant, etc. The whole design exists for one number. A rider reaches your door in 10 minutes because the stuff is already sitting a few hundred meters from where you're standing right now. That's the machine. Thousands of these little boxes blanketing the metros. Zepto alone runs over 1100 of them, about 1139 as of March 2026. And one more term because the entire fight comes down to it: unit economics. 10 rupee word, 1 rupee idea. It just means on one single order, your box of eggs, do they make money or lose money after paying for everything that order actually cost? Forget the $1 billion valuation. One order, plus or minus. Hold that thought, because that is the whole game. Now, the version you've heard, and it's not the fake one, the numbers are genuinely insane. This sector basically didn't exist in India before 2021. By 2025, quick commerce was moving something like $11 billion of goods a year. And the projections in Zepto's own IPO papers say it could be 5 to 7 times bigger by 2030. 60 to 80 billion dollars. Now that's Zepto's own bullish number. Independent forecasters are pegging it lower, but even those numbers are still insane. Zepto went from a dorm room idea by two 19-year-olds to handling over 1.75 million orders a day. Revenue more than doubled in a single year to over 22,000 crores. Valuations rocketed into the billions. Every investor wanted in. The headlines basically wrote themselves: India's instant delivery miracle. All of these companies kept talking about explosive growth, but most of them were losing money on it. And not just a little, torrents of it. This is the part the boom story skips. The strategy was never deliver groceries and pocket the margin. The strategy was burn cash to buy customers, subsidize every order, drown the city in discounts, hook you on convenience, and keep going until your rivals run out of money first. Think about what that actually is. It's not a gold rush where everyone digs and everyone wins. It's a game of chicken. Two cars driving towards each other, full speed. Whoever swerves first, whoever runs out of investor cash and has to stop subsidizing, loses. The winner isn't the best app or the cleverest ad. It's the last one standing with money in the bank. And for years, that was fine because the cash was patient. Venture capitalists and SoftBank types were happy to fund the bonfire, betting that their horse would be the survivor and own the whole market. Honestly, they were funding a war and they knew it. Which raises the obvious question, the one this whole video is built on. If everyone's losing money on every order, where does the money actually go? So let's follow the rupee. Okay, so let's open the hood on one order. This is the heart of it. Stay with me, you don't really need a finance degree for this. You order groceries from one of these apps today. Say your basket of the total order is around 500 rupees. And that's a rough sector ballpark because Zepto actually runs lower and Blinkit and Instamart run slightly higher than that. The company doesn't really keep the 500, of course, they keep a margin on the goods. The gap between what they paid the brand and what you paid them. On groceries, the margin is always extremely thin. It's a very brutal business. Everyone from your local kirana to big basket fights over single digit percentages. But for the sake of this example, let's just say they made 80 to 100 rupees of gross margin on your basket of 500. Feels fine, right? Now watch it bleed out. The rider. Someone physically rode to a dark store, grabbed your stuff, and drove it to you. That costs real money per trip. And you probably got free delivery on this order. The dark store. Rent in a dense urban neighborhood, electricity, the staff inside picking and packaging. Spread that across the orders that store does in a day. The discounts. If you remember at the beginning when all these apps were new, a lot of them would offer insane discounts. Randomly, they would give you 100 rupees off, offer you free delivery, give you cash back based on whatever cards you were using, etc. Wastage. Since they are dealing with groceries and perishable items, some of it does spoil. Milk, fruit, vegetables, that's money rotting on a shelf. Stack those up, and for years across the industry, the costs came out to more than the 100 rupees gross margin that you helped them with. Which means every convenient order quietly lost the company money. And here's the uncomfortable bit, that means you were never really the customer, you were a subsidy recipient. Every time that order felt like a steal, it was. Somebody was eating the difference, so you'd keep tapping on their app. So, how does anyone make money here exactly? There are three main levers and only three. Number one, bigger baskets. If you order rupees 900 worth of items instead of 500, the rider and the rent costs the same. So more of that order is pure profit. Number two is ads. This is the quiet one. These apps now charge brands to show up first when you search chips, for example. That's pure profit money that has nothing to do with delivering anything and doesn't cost them that much. Number three is private labels. They can start creating their own brands of atta, almonds, paneer, where their margin is extremely fat because there's no middleman to pay. Bigger baskets, ads, own brands, that's the entire path out of the pit. Everything else is just buying time. This now brings us to the two main characters. Same business, opposite balance sheets. And that gap is the story. Blinkit, owned by a company called Eternal, which is just Zomato with a new name. It rebranded in 2025. Blinkit hit the thing nobody in this sector had hit. It actually turned a profit on its quick commerce operations. The first major player to post positive adjusted earnings, about rupees 37 crores of adjusted EBITDA in the March 2026 quarter. Small, fragile, but still green. It did prove that the model has the ability to work. On the other hand, Zepto, growing like a weed, second biggest player in the country, and last year it lost nearly 6,000 crores, up from 4,700 crores the year before. Let me read that again. They lost 6,000 crores last year from 4,700 crores the year before. Not revenue, loss. Its revenue actually doubled to over 22,000 crores, which sounds amazing until you realize it spent even faster to get there. Now, in fairness, and this matters, Zepto's losses are getting less bad per order. Its adjusted EBITDA loss on each order dropped from rupees 136 to rupees 79 in a year. So the trend isn't exactly hopeless. But losing less is not making money. One company has proven it can stand on its own. The other is in a race against its own bank balance. And that's not a small distinction. Because if your rival has figured out how to be profitable, they can keep going forever. You, still burning cash, cannot. Which is exactly why 2026 has become the year Zepto had to make a move. Here's the part that flips the whole thing. When a hot startup goes public, does an IPO, we're trained to read it as a victory lap. The founder rings the bell, everyone's a billionaire, you made it, here's your trophy. For Zepto, I'd argue it's something else. It's sort of like a refuel, like an F1 car stopping into the pit lane, low on fuel, tires wearing off. On 9 June 2026, Zepto filed updated papers to raise 8,000 crores in fresh capital from the public market, targeting a listing around July to September. Look at the timing. The patient venture money has largely dried up. Investors want their money back now, not another decade of bonfire. Some of Zepto's early backers, like Nexus, Contrary, and others, are even selling part of the stake on the way out through the offer for sale. So, where do you get fresh fuel to keep fighting a profitable, deep pocketed Blinkit? You go to the public, to us. Remember, for 4 years, investors were the ones eating the loss on your biscuits. The IPO is the moment that bill gets passed around. It isn't the finish line, it's Zepto walking into the pit lane, low on fuel, hoping the retail investor fills the tank for the next lap of the war. And the timing gets sharper. Eternal's quarterly results land around mid to late July. That's its usual Q1 reporting window, and that'll be the first real read on whether Blinkit's fragile profit survives on all out price war or gets torched the moment the fighting heats up again. Two dated events, weeks apart, both inside this window. A quick important line that I want to put in here, and I really mean it. This is not me telling you to buy or skip the Zepto IPO. I have no idea what the right price is, and anyone on your feed who claims certainty about a brand new loss-making listing is selling you something. I'm here to show you the machine so you can judge it for yourself. And if you think this is just a two-horse race, Blinkit versus Zepto, here's where it gets brutal. It is simply a pylon. Once Blinkit proved there might be a real money-making opportunity here eventually, every giant in India came crashing in. Swiggy, Instamart, Amazon, Flipkart, JioMart, Big Basket, all of them are lining up to get into quick commerce. Now line that up against the chicken game from earlier. Zepto and the smaller players are pure plays. Quick commerce is all they do. If the cash runs out, they die. But Ambani and Tata and Amazon, quick commerce is just a rounding error for them. They can fund losses out of petty cash for years to come without batting an eyelid. Not because it's smart, but because they refuse to let a rival own your doorstep. Do you see the trap here? The presence of giants who don't even need this to be profitable can keep the whole sector bleeding way longer than the smaller brands have money in the bank. The deepest pockets, not the best operator, can set how long the war runs. That's the second order effect nobody put on the magazine cover. Now, let me just argue against myself, because if I only sell you the doom, I'm doing exactly the thing that I just mocked. Here's the bull case, and it's quite strong actually. Number one, 10-minute delivery failed in the West. But India is different, and not in a hand-wavy way. Our cities are insanely dense. A single dark store here can reach tens of thousands of people in an 8-minute ride. Economics that simply don't exist in spread out American suburbs. The thing that killed it there might be exactly what makes it work here. Number two, Blinkit already flipped to profit. That's not a projection. It actually happened, which means they're all burning cash forever is, at least for the leader, already wrong. Number three, it's all a bubble has been the lazy, confident take on Indian tech for a decade. And it was wrong about UPI, and it was wrong about a lot of other things. Maybe 2 or 3 of these players don't die at all. Maybe they become a permanent infrastructure. So the honest answer is some of these companies are walking corpses and some are building the future. And this same price war decides which is which. Don't let anyone, including me, flatten that into a clean story. The truth is, it's a war with survivors, not a bubble where everyone vanishes. So here's my honest question, and I actually want your answer. Is quick commerce real infrastructure will all depend on in 10 years, or a beautiful deal we're all enjoying right up until the cash runs out? Tell me below which app is on your phone right now, and would you put your money into the Zepto IPO? I'm reading the comments on this one. And if your nani still keeps a list for the kirana down the street, maybe don't throw it away just yet. Thank you so much for listening. This has been Ayush from Mind on Motion, and I'll see you guys in the next one.